Hey, what's going on? It's Brad here with a very simple video today explaining how to calculate your net worth. Net worth is one of the most important metrics you can track to keep an eye on your overall financial picture. It doesn't just apply to celebrities and billionaires. I know we always see the headlines of like, this billionaire's net worth grew by X percent over this period of time or whatever. But the truth is, we all have a net worth. And if you're trying to get ahead financially, it's a good idea to know what yours is. So in this video, I'm going to break down what net worth is, why it matters, and how to calculate it step by step. Plus, I'll give you a couple of tips on how to grow it over time. So let's get into it. At its core, net worth is simply the value of everything you own minus everything you owe. It's calculated with a really simple formula. Net worth equals assets minus liabilities. Assets are things you own that have value, like cash, investments, your house, your car, and even valuable personal items. Liabilities are debts that you owe, like credit card balances, student loans, car loans, and mortgages. So when you add up all of your assets and subtract your liabilities, the resulting number is your net worth. Let's take a closer look. To calculate your net worth, you'll want to start by listing out all of your assets. This includes cash and bank accounts, checking, savings, cash on hand, your investments, so stocks, bonds, retirement accounts like your 401k and IRA, real estate, crypto, and so on. Your home, so if you own a house, you want to take the current market value of your home. You can use something like Zillow to estimate this. Your car, same thing. You can use Kelley Blue Book to estimate the current value of your car. And finally, any other valuable items that you own. This would include things like jewelry and collectibles, anything that holds real value. Now, don't get carried away adding every single thing that you own, your furniture, your couch, your TV, your clothing. These things are probably not going to count unless they're rare or particularly valuable for some reason. Focus on assets that can actually be sold for a meaningful amount of money. So total up everything here and you'll have a number for your assets. And put that number aside. Next, we need to calculate your liabilities. So you'll want to list out all of your debts and financial obligations. This will include credit card debt, so any outstanding balances you have on your credit cards, student loans if you have them, car loans, mortgages, and any other debts that you have like personal loans, medical bills, and so on. Now, importantly, as you're taking inventory of these loans, you only need to take the outstanding balance into account, meaning the amount that you still owe on the loan. Once you've got those numbers, go ahead and add them up and you'll have your total liabilities. Now it's time to do the math. Again, this is very simple. Take the total value of your assets and subtract your liabilities. For example, let's say your assets come out to a total of $100,000 and your liabilities come out to $40,000. $100,000 in assets minus $40,000 in liabilities comes out to a net worth of $60,000. Now, I should mention, it may be that your net worth is actually negative. If that's the case, don't panic. That's very common, particularly if you have student loans or I guess any type of debt, right? It just means that you currently owe more than you own, and you can always improve on this number over time. In fact, that's what this is all about. Your net worth is one of the best ways to measure actual financial progress. A high income is great, but if you're spending all of it and not building assets, you won't actually build wealth. Very simply, your net worth shows whether you're getting richer or poorer over time. If it's increasing, you're on the right track. If it's decreasing, that's an indication that you may need to adjust some things. So how exactly do you go about increasing your net worth? Well, because it is such a simple formula, there are really only two ways to do that: by increasing your assets and reducing your liabilities. Now, how do you increase your assets? Well, you can save more money, you can invest more, you can buy assets that appreciate over time, whether that be index funds, real estate, and so on. You can start a business and build equity in that. And then to reduce your liabilities, you want to be paying off debt aggressively, especially high interest debt like credit cards. Ideally, you'll be doing both of these and sort of attacking the formula from both sides. Now, of course, one of the biggest levers you can pull to grow your net worth faster is increasing your income. More cash flow means you can invest more, pay down debt faster, and build your financial foundation faster. Whether that comes from negotiating a raise, picking up a side hustle, starting a business, or building out additional income streams, increasing your earnings gives you more flexibility and accelerates the process of growing your wealth. But again, income and net worth are not always directly correlated. It's possible to make $1 million a year and still have a negative net worth. So it's important to make sure that some portion of your income at whatever income level you're at is always going toward increasing those assets and reducing those liabilities. So now you know exactly how to calculate your net worth and why it's such an important metric to track. If you've never done this before, take 5 or 10 minutes today, write down your numbers, and figure out where you stand. And remember, it doesn't matter where you start. What matters is that you track your progress and keep moving forward. If you found this video helpful, do me a favor, hit that like button, subscribe for more personal finance videos, and let me know in the comments, what's your biggest financial goal right now? I'll see you in the next one.